Mortgage rates just did something most homeowners were told wouldn't happen again this year, and the reason behind it is stranger than anyone expected. If you're planning to buy a home, sell one, or refinance in the next 12 months. What I'm about to walk you through could completely change your timeline, and I promise, the twist at the middle of this video is not what you think it is. Before we get into it, if you find value in breaking down the real story behind the numbers, hit like on this video and subscribe to the Daily Finance so you never miss what's coming next in the housing market. Now let's get into what's actually happening. This week, the average rate on a 30-year fixed mortgage climbed to its highest level in months, and depending on which lender or which tracking source you look at, some readings are brushing up against levels not seen in nearly a year. Freddie Mac's weekly survey showed the 30-year fixed rate moving up to 6.55%, a jump from 6.49% just 7 days earlier. The Mortgage Bankers Association reported an even sharper climb, with their measure hitting 6.65%, matching a 9-month high that was last touched back in May. Different surveys, slightly different numbers, but the story underneath them is exactly the same. Money that was getting a little cheaper just a few weeks ago is now getting more expensive again, and buyers who were starting to feel a small window of relief just watched that window start closing. Here's what almost nobody explains clearly when a headline like this hits your feed. Mortgage rates are not set by some committee that decides what number sounds fair for homebuyers. They are priced off the bond market, specifically off something called mortgage-backed securities, which themselves move in close relationship with the yield on the 10-year U.S. Treasury note. Think of the 10-year Treasury as the baseline cost of borrowing money in the entire economy. When investors demand a higher return to hold that 10-year bond, mortgage rates rise right along with it, because lenders need to earn enough on your loan to make it worth bundling and selling to investors who could otherwise just buy treasuries. So when you hear that Treasury yields spiked because of inflation worries, that is not some disconnected Wall Street story. That is the actual mechanical reason your monthly payment on a new home just got more expensive. And this is where the story gets genuinely strange, because the reason yields have been climbing lately is not the reason most people assume. For the last 2 years, the entire narrative around mortgage rates has been built on one simple idea, that rates go up when the economy is too hot and they come down when the Federal Reserve starts cutting. That story made sense back in 2022 and 2023, but right now we're watching something different play out. Inflation data has stayed stickier than expected, and at the same time there's growing chatter in the bond market that the Fed might actually need to raise rates later this year instead of cutting them, even while the labor market is showing gradual signs of cooling. That combination, inflation refusing to fully die down while job growth softens, is exactly the kind of mixed signal that makes bond investors nervous, and nervous bond investors demand higher yields to compensate for uncertainty. That uncertainty is the real engine behind this rate spike, not some simple story about a booming economy. Let's rewind for a second, because context makes this so much easier to understand. Back in 2020 and into early 2021, 30-year mortgage rates were sitting under 3%, some of the lowest levels ever recorded in American history. That happened because the Federal Reserve slashed short-term rates to near zero and bought massive amounts of mortgage-backed securities to keep the housing market from collapsing during the pandemic. Millions of Americans refinanced during that window, locking in payments that, looking back now, seem almost unbelievable. Then starting in 2022, the Fed began the most aggressive rate hiking campaign in 4 decades to fight inflation that had climbed to a 40-year high. Mortgage rates followed, rocketing from under 3% to over 7% within about 18 months. That speed of change was almost unheard of, and it fundamentally reshaped how Americans think about buying a home. But here's where things get interesting. And this is the part almost nobody talks about when they cover this topic. That rapid rate spike created something economists now call the lock-in effect. And it is still shaping the market today, years later. Millions of homeowners refinanced or bought during that ultra-low rate window between 2020 and 2021, and now they are sitting on mortgages at 3% or even lower. Selling that home and buying a new one today, even a smaller or cheaper one, means trading a 3% rate for something in the mid-6% range. For a lot of families, that math simply doesn't work, so they stay put. They don't sell. That single decision, multiplied across millions of households, is a massive reason why housing inventory has stayed so tight for years, even as rates fluctuate up and down. So when you hear rates hit a new high, understand that the ripple effect isn't just felt by new buyers, it's also felt by the entire supply side of the market, because it convinces even more existing homeowners to just stay where they are. Now let's talk about what this actually costs someone in real numbers, because percentages on a screen don't mean much until you translate them into a monthly payment. On a mortgage of $400,000, the difference between a rate of 6% and a rate of 7% is roughly $270 more per month. Over the life of a 30-year loan, That gap adds up to almost $100,000 in additional interest paid. That's not a rounding error, that's a car, a year of childcare, a meaningful chunk of a retirement account. This is exactly why even small moves in the rate, moves that look tiny on a chart, like going from 6.49 to 6.65%, translate into real monthly stress for a family trying to make a home purchase work within their budget. I want to walk you through a quick example because it makes this click in a way numbers alone don't. Imagine a young couple who started house hunting back in June when rates were touching some of their lowest levels of the year. They found a home, ran the numbers, and felt like the monthly payment was tight but doable. The negotiations dragged on for a few weeks, inspections happened, financing got sorted out, and by the time they were ready to lock their rate, the market had shifted. The same loan that would have cost them one number in June was now costing more simply because of timing they had zero control over. This happens constantly in real estate, and it's one of the most frustrating parts of the entire buying process, because unlike the price of the home itself, which you can negotiate, the rate environment is completely outside your control. So what's the myth almost everyone believes but shouldn't? A lot of people assume that when the Federal Reserve cuts its benchmark rate, mortgage rates automatically drop right along with it. That is not how it works, and this misunderstanding causes a lot of bad financial decisions. The Fed's benchmark rate, called the federal funds rate, controls short-term borrowing costs, things like credit cards and short-term business loans. Mortgage rates are long-term and tied to that 10-year Treasury yield we talked about earlier, which reflects expectations about inflation and growth over the next decade, not just what happens at the next Fed meeting. In fact, there have been stretches in recent years where the Fed cut its short-term rate and mortgage rates barely moved, or even rose slightly, because bond investors were more worried about long-term inflation risk than short-term borrowing costs. This is exactly the disconnect we're watching happen again right now. Here's where the story shifts into something a lot of people find surprising. Even with rates climbing back up, purchase activity has been the part of the market taking the biggest hit, with applications for new home purchases dropping noticeably in the most recent weekly data, while refinance applications actually increased. That seems backwards at first glance, right? Why would people refinance into a higher rate? But when you dig into it, a good portion of refinance activity right now isn't about chasing a lower rate at all. Some homeowners are doing cash-out refinances to pay for renovations, consolidate higher interest debt, or fund major life expenses, and they're willing to accept today's rate because their existing loan might be an adjustable rate product, resetting to something even worse, or because they need the liquidity regardless of the rate environment. This tells you something important about where we are in the cycle. The easy, obvious refinancing wave from years ago is over. What's left now is need-based activity, not opportunity-based activity, and that's a meaningfully different signal about the health of the housing market. Let's talk about the psychology of all this, because the emotional side of the housing market matters just as much as the math. Right now, a lot of prospective buyers are stuck in what I'd call a waiting game mentality. They've convinced themselves that if they just wait a few more months, rates will drop significantly and everything will suddenly become affordable. This is a very human instinct, but it's also a trap. Nobody, not economists, not the Fed, not the bond market itself, can reliably predict short-term rate movements with precision. Waiting for a perfect rate often means missing years of home equity growth. Often worse, if home prices keep rising in your target area while you wait for the rate to drop, you might end up paying more in total even if you eventually get a slightly better rate. This is one of the most important lessons in personal finance broadly, not just housing. Trying to perfectly time a market almost always costs you more than it saves you. But I also don't want to swing too far the other direction and pretend timing doesn't matter at all, because it does, just not in the way most people think. What actually matters more than guessing the market is controlling the things you can control. Your credit score is one of the biggest levers you have. The difference between a 620 credit score and a 760 credit score can swing your mortgage rate by half a point or more, which, on a $400,000 loan, is thousands of dollars a year. Freddie Mac's own research has consistently shown that getting even one additional rate quote from a different lender saves borrowers real money over the life of the loan, and getting 3 or more quotes can save significantly more, simply because lenders don't all price risk the same way. Shopping around isn't a nice to have, it's one of the single highest leverage financial decisions you can make in this entire process, and it costs you nothing but a little bit of time. Now here's something that might surprise you, and it connects directly back to that mixed signal we talked about earlier. Despite rates climbing, several housing data sources are actually reporting that affordability conditions have been modestly improving in certain markets. Not because rates are falling, but because housing inventory has been slowly rising and price growth has been cooling in a lot of metro areas. This is the part of the story that headlines about rate spikes almost never mention. A rising rate environment paired with a slowly rising supply of homes for sale creates a very different market than a rising rate environment paired with a supply shortage. In the first scenario, sellers start competing a little more for buyers, price growth slows, and buyers can sometimes negotiate concessions like the seller covering closing costs or a rate buydown. In the second scenario, which is closer to what we saw in 2021 and 2022, buyers have almost no negotiating power at all. Understanding which of these two environments you're actually in matters far more than obsessing over the headline rate number by itself. This is exactly why so many experienced real estate professionals will tell you that the rate is only one piece of a much bigger equation. The total cost of homeownership depends on the purchase price, the rate, property taxes, insurance, and how long you plan to stay in the home. A slightly higher rate on a home you got at a great price, in a market with room to negotiate, can end up being a better financial decision than a slightly lower rate on a home you overpaid for during a hyper-competitive bidding war. Well, this is a lesson that took a lot of buyers years of expensive mistakes during the pandemic boom to fully understand, and it's worth internalizing now before you find yourself in a similar high-pressure situation. Let's circle back to that bigger economic question, because it's the thread tying this entire story together. Why are bond investors suddenly worried enough to push yields and therefore mortgage rates back up toward these levels? Inflation readings over the past several months have not cooled as quickly or as smoothly as many economists initially hoped. At the same time, there's a growing conversation in financial markets about whether the Federal Reserve might need to consider raising rates again rather than cutting them, which just a year ago would have sounded almost unthinkable to most analysts. This creates genuine uncertainty, and financial markets hate uncertainty more than almost anything else. When investors aren't sure whether the Fed's next move is up or down, they price in extra risk, and that extra risk shows up directly in the yields on long-term bonds, which flows straight through to your mortgage rate. This is the real answer to the question we opened this video with. It's not simply that the economy is strong or the economy is weak. It's that nobody has a confident read on which direction things are heading, and that confusion itself is expensive for anyone trying to borrow money right now. So what does all of this actually mean for you, depending on where you sit in this market? If you're a buyer, the lesson isn't to panic or to freeze up waiting for a perfect number that may never come. The lesson is to get your financial house in order now, meaning your credit score, your debt-to-income ratio, and your down payment savings, so that whenever you do find the right home, you're able to move quickly and lock in the best rate available to you at that moment, rather than scrambling last minute. If you're a current homeowner sitting on a low rate from a few years ago, this environment reinforces exactly why so many people are choosing to stay put and renovate instead of sell and rebuy. And that's a completely rational decision that's reshaping housing supply nationwide in ways we'll likely feel for years to come. And if you're someone considering a refinance, the math has become much more selective than it used to be, meaning it typically only makes sense now if you have a specific need, like consolidating higher interest debt or getting out of an adjustable rate loan that's about to reset even higher. There's one more piece of this puzzle that ties everything together, and it's something most coverage of mortgage rate news completely skips over. The relationship between rates and home prices is not a simple seesaw where one always goes down when the other goes up. In a lot of markets right now, we're seeing rates rise while prices stay roughly flat or even dip slightly, because higher borrowing costs are naturally cooling buyer demand at the same time. That means the total monthly cost of owning a home isn't necessarily spiking as sharply as the rate headline alone would suggest, because the price side of the equation is adjusting too. This is exactly how markets are supposed to self-correct over time, and it's a much healthier dynamic than what we saw during the pandemic boom, when prices and demand were both surging uncontrollably at once. If there's one single lesson I want you to walk away with from everything we've covered today, it's this. Mortgage rates hitting a multi-month or near one-year high is not a reason to panic, and it's not a reason to assume the housing market is collapsing or booming. It's a signal, one piece of a much larger and more complicated economic story involving inflation, bond yields, Federal Reserve policy, and buyer psychology all colliding at the same time. The people who make the smartest decisions in this environment aren't the ones trying to perfectly predict where rates go next. They're the ones who understand the mechanics well enough to make calm, informed decisions, regardless of which direction the headlines are pointing that week. I want to hear from you directly on this one. If you're currently shopping for a home or you're sitting on a rate from a few years ago and deciding whether to stay or sell, drop a comment below and tell me what your experience has actually been like in this market, because real stories from people living through this are honestly more valuable than any headline number I can put on a screen. If this video helped you understand what's actually driving the housing market right now, do me a favor and hit that like button, subscribe to the Daily Finance if you haven't already, and turn on notifications so you don't miss the next breakdown the moment it drops. Because next time, we're diving into a question that might completely change how you think about where the real estate market is headed over the next 2 years. And trust me, you are going to want to see the data behind it.